Hello, and welcome to myfinanceteacher.org. In this video, we're going to have a look at what's happening to gold right now, and a larger part of this video is going to be dedicated to what's going to happen to gold over the next couple of years based on the performance of gold price versus CPI, or the Consumer Price Index. That index is actually used to measure inflation. Before we start though, I want to thank you if you are watching this at myfinanceteacher.org. This video will also be made public later on, maybe after 1 or 2 weeks. So if you're watching this video on YouTube, why not check us out at myfinanceteacher.org, where the members get nearly daily updates from me on a range of assets, including cryptocurrencies, general stock market, precious metals, gold, silver, and energy-related assets. In addition, I have a colleague who writes these weekly newsletters where he shares his investment experience that he's accumulated over a number of decades. Now, let's start with the short-term view of gold. As we have been expecting for a number of weeks already, we've actually been a little bit early with our expectations for this drop. But anyway, as we have been expecting, gold is now correcting, and it was time for correction based on how overbought it was. At the moment today, the ongoing short-term daily cycle is 68 days old. So it is possible that the low today, which was somewhere at about $1,864, might be the low and the end of the ongoing short-term daily cycle. If that is the case, then gold might bounce for another 1 or 2 weeks before dropping into the end of the next short-term daily cycle, which will also be the end of the intermediate half-a-year cycle in gold. But this cycle is not extremely stretched yet, so there is also a chance that the decline continues for just another few days, because I think this drop down to 1864 hasn't really reached any of the significant support zones. One of those significant support zones would be this 50-day moving average, which is at about 1830. Another one would be from the early July tops at about 1820. So for that reason, I think there is still a chance, maybe not a huge chance, that gold continues down for just another few days. Although on the other hand, you might say that if you connect some of the recent lows, you will actually see that today at the day's low, gold retested this trend line that it's been respecting for quite a number of months already. So another possibility for the ongoing short-term daily cycle is that, well, we have actually retested a significant enough support zone and the new daily cycle is starting, which would imply a possible bounce for 1 or 2 weeks. So in my opinion, the split between these two scenarios is close enough. Let's say 55% chance that the drop continues for another just a few days versus only 45% chance that gold bounces up for 1 to 2 weeks. In either case, over the next couple of months, I would expect gold noticeably lower, very likely below the 50-day moving average and much closer to the 200-day moving average. Maybe at least a retest of a round number of $1,800 over the next couple of months within the declining phase of the intermediate as well as the next short-term daily cycle. Maybe even lower than that, maybe a round number of $1,700, which would, well, possibly be close enough to this 200-day moving average by then. In either case, I'm not jumping in at the moment, although it's an interesting idea to try to catch this short-term bounce. But if I do try to catch that, I would only allocate a very small amount of money to this bounce with relatively tight stop losses. I would concentrate mostly on trying to catch the end of the half-a-year intermediate cycle over here sometime in another couple of months. Looking at the Optimism Index, with the recent drop in gold price, Optimism Index dropped from above 80 to just above 60. It's at 61 at the moment. And catching both the short-term daily cycle low or even the half-a-year intermediate cycle low might actually be a little bit tricky in gold price, because looking at this history of several years, the intermediate cycle lows came at quite different readings for this optimism index. For example, in late 2018, the intermediate cycle in gold only finished when almost everyone was extremely pessimistic. Something similar happened somewhere in the middle of 2019, again, very low optimism index. Whereas more recently, in the last couple of intermediate cycle bottoms, the pessimism wasn't actually that low. It was relatively close to a level of 50 rather than 30. The previous cycle low was actually at above 50, somewhere at about 54. But in either case, as long as we're above 60, it's clearly too early to think of jumping back into precious metals. After all, let's look at this dollar index. Over the last couple of months, the negative correlation between dollar index and gold price, this is the bottom part of the chart, has re-established again. So looking at dollar might be somewhat useful. And we see that the short-term daily cycle in dollar very likely finished on the 5th of August, after RSI was quite deep into oversold and dollar actually gave us multiple pokes through the low range of the Bollinger Bands. Over the last few days, dollar is strengthening, but if the dollar is in the new short-term daily cycle, which is very likely, then this dollar rally is likely to continue to at least retest this 50-day moving average and the upper range of the Bollinger Bands, as this cycle is still very young. So very likely strength in the dollar over the next several days, which kind of tells me that, well, some caution is still advised in gold. While in the short term, some caution is advised, let's actually look at what's likely to happen to gold over the longer term, let's say into the year 2022. And similar to what I did in my recent video when I looked at the relationship between gold and M2 money supply in the US, link to that video at the top of your screen right now. In this video, we're going to look at the relationship between gold price and CPI, Consumer Price Index. This index is often used to measure inflation, to see what that relationship between CPI and gold price tells us about possible future gold price over the next couple of years. And in my opinion, it's actually more important to look at CPI versus gold price than money supply versus gold price, because not all extra money created might actually be translated into inflation. So CPI is a slightly more direct measure for inflation rather than simply the total amounts of money being printed. And inflation in turn, of course, would push prices of a range of assets higher, including precious metals, including gold. So again, just like in that previous video, we're going to look at key points over the last 20 years. And these key points are the beginning of the previous bull market in gold. That's in April 2001. Next key point is in the middle of 2006, followed by the previous all-time highs in gold. That's in August-September 2011. Next key point is going to be the bottom of the previous bear market in gold. That's in December 2015. And lastly, I'm going to look at July-August this year, when gold price was somewhere around $2,000. Looking at CPI, I'm going to use the data from the Fed and look at CPI numbers for the similar key points: 2001, 2006, 2011, 2015, and current level. If I plot gold price on the vertical axis versus CPI on the horizontal axis, this is the chart I would get. $260 per ounce of gold back in 2001, $700 per ounce of gold back in 2006, $1,900 in 2011, only $1,100 in 2015, and 2000 recently. This chart gives me a trend line shown by this straight black line, and based on this trend line, I can calculate this fitted or expected gold price based on the relationship between CPI and gold price. And this fitted or expected gold price will also help me to decide whether ongoing current gold price is over or undervalued. For example, back in 2001, gold price was just slightly under the fitted or expected gold price, so there was some slight undervaluation. A little bit more of undervaluation in 2006, overvaluation at the top of the bull market, and so on. So Let's have a look at the chart of that extension or over versus under valuation. The blue line here is the actual gold price. The red line is the fitted or expected gold price based on the relationship between gold and CPI. And the black line is this extension, which shows over or under valuation. I've just noticed that I forgot to edit the ranges for the horizontal axis, but basically this is April 2001, this is the middle of 2006, August 2011, December 2015, and July-August 2020. So 6% undervaluation in 2001, 15% undervaluation in 2006, 43% overvaluation at the top in 2011, 29% undervaluation back at the bottom of the bear market in December 2015. And at the price of $2,000, gold is just 1% overvalued compared to how it's been performing versus CPI over the last 20 years. Now let's finally have a look at our projections into 2022. As the bull market in gold continues, this extension, this overvaluation of gold price is likely to increase. Let's be conservative here. Let's say it's going to only increase to 40% overvaluation versus 43% overvaluation in August 2011. How about CPI? With trillions and trillions of dollars being printed, especially recently, as the joke goes, with the printer going brrr, you would probably expect a lot of inflation over the next several years. But again, let's just even be conservative here. Let's give it, say, 4% inflation in 2 years. So that's only 2% inflation per year. So 4% on top of ongoing CPI gives me 268. So let's put 268 here, bam, and that gives me a gold price of $30.70, over $3,000 per ounce. That's if in the ongoing bull market over the next couple of years, the overvaluation of gold compared to how it's been performing versus CPI increases from only 1% overvaluation to 40% overvaluation. It's not impossible given that previous overvaluation was 43%, and given that inflation over the next couple of years will only be 2% per year. That projects a gold price of above $3,000. And that actually corresponds pretty well with our previous projection, where we've seen the gold price of above $3,200 if money supply increases to 19 trillion over the next couple of years. So there you go. Although in the very short term, some caution is probably advised, over the longer term, over the next few years, I think gold and silver are going to do amazingly well. Let me know what you think in the comments. I always appreciate constructive ones. I also appreciate if you hit that like button and share a link to myfinancesteacher.org with your friends. For now, I wish you a wonderful day and good luck in your trades.